We are back in the black hole of real estate, and this week I wanted to talk about what is going on with the state of the market with regards to whether or not you should buy a home between now and the end of the year or just wait into the future. And right now, the biggest negative towards it is interest rates. And I believe that that is something that is getting in the way of most people actually making a move to a home that they really want to be in because they feel that the cost is just going to be too high and it's just not the right time for it. And I think that within that, well, there's a couple of mistakes that might happen unintentionally by that delay. Now, the first thing is that sellers right now are motivated because we're not seeing multiple offers above the asking price right now. Now, inventory is still low, but there's an attentive seller, many of which need to sell by the end of the year, either for a move for business or life, or maybe tax purposes. So, right now, there is this window of opportunity for a buyer if they can overcome the rate. And I'm going to talk about that in a little while. But right now, you certainly could ask the seller to give you a concession, either help with your closing costs, which for some families would really help, especially around the holidays. But if you have your down payment and closing costs covered, you see, then you can use that money towards an interest rate buy down. And many times that buy down could lower the rate this year and next year before settling into whatever the rate's going to be 2, 3 years down the road. So we can look at things like 2-1 buy downs to suppress the interest rate right now to make it more affordable today. So I think looking at 2-1 buy downs definitely a good idea. Getting closing costs back from the seller probably is more likely this year than last year. Now, when we also think about the condition of the home, I think it's fair to say that the as is contracts that we've experienced the last few years still say as is on them, but I believe that sellers are more open minded to do the little repairs to get the property ready to go on the market. And then if something came along that also needed attention, well, I think that the sellers are also willing to do those type of things. So I think repairs are super important right now. A roof to be put on a property right now in order for it to qualify for financing is real. We've had several this year where the owners have paid to put the roof on for the new buyer. And that's different because when it's a crazy market and people are paying way more than the asking price for it, try to ask for a roof in the midst of that, well, it's not likely. And now that's changing. And I do believe that's a super important thing to consider right now as we're in this time period where you can ask a little bit more of the seller and they're more open minded about doing it. How about negotiation? Do you think this is a good time of year to be able to walk into a seller and offer less than the asking price and maybe get a positive result? Because we're seeing that too. Now, I would admit that some of the properties on the market are overpriced and the prices that they're selling for are normalized to this market, but there still is this opportunity to offer less than the asking price and strike a deal. So I think that's pretty interesting. We don't need to think so much about waiving inspections anymore. I just talked about how sellers are more open minded about doing repairs. And in this market, I don't know that I would write any offers that don't have an inspection period, especially with the insurance piece in there. I would want to make sure at the very least I could do a 4-point inspection to give it to my insurance company to get the best possible rate or identify things that would get in the way of me getting a strong rate. So I would want to be able to do that. A contingent contract, buying a house subject to selling your house. We've had to give up a lot of liberties over the past few years to get deals done. But now we have several deals under contract where this seller, or excuse me, the buyer still has to sell their house in order to give the money to the seller at closing. So contingent contracts never went away, but there's more of them now. So they're back. And you might be able to breathe a little bit on your loan approvals. and trying to get things done in 22 days, well, maybe the 30 or 40 days you might need for a government loan like an FHA or a VA, are those timetables just a little more reasonable right now? So a lot of things that are stacking up for buyers in this market that were not necessarily on the table before. So when somebody asks me, when's it a good time to buy? Well, when you're ready. And if you find that you're in a home that's not quite big enough or far too big for your needs or not close enough to work or something has changed, preventing yourself from being there because of an interest rate, I just think we need to look at this piece from a little different angle. Because so far the only thing I come up with is that interest rates are too high. So how do we combat that? Well, we talked a little bit about a 2-1 buy down. Now what that means is having the seller prepay some of the interest over the next 2 years to make your rate lower. You see the difference between the interest rate, and let's just say that rates are, 8%, 7%. Make it 2% lower, 6 or 7%. Big difference in your monthly payment. And let's say it's $100 or $200 a month. Oh, let's have fun. Let's say it's $200 cheaper by doing it. Okay, great. So for 12 months, it's $2,400 in savings. So that can be looked at. In the next year, maybe it's $1,200 cheaper, and that can be looked at as well. That $3,600 cheaper in the monthly mortgage payment is just a fee. You're just prepaying some of that mortgage in advance. That's part of a 2-1 buy down. It's the simplest way I can explain it. So if the seller's willing to give you $3,600 credit at closing, that probably pays for your buy down. So you have a mortgage payment $200 cheaper the first year and $100 cheaper than the normal interest rate would be. And after that, you figure it out. By that time, you've got bonuses, raises, and opportunities at work. You're making a little more money. You've grown into the house. You've paid a few things off, and it works. So 2-1 buy down, absolutely way to go. And we've got some great lenders that do a lot of that type of work. So super interesting. You can also go to a company that offers a free refinance, and some lenders are doing this. We work with one that does up to 5 years that they'll waive all the lending fees in order to do a refi. So if the rates go down in the next 5 years and you use that lender, you're not going to have any lender's fees. So that's a way to do it too. And I do believe that most people feel that rates will come down, whether it's next year or the year after, or quite a bit. Then a refinance does make sense down the road. We're hearing a lot of strategies, but I just think that you can marry the house and date the rate. Go buy the house. Figure out the rate down the road, because you can use a buy down now, have the seller pay for it. You can absolutely refinance down the road at no cost with a lot of lenders right now, up to 5 years. So there's some protection built in there. Could you tough it out for a year and pay an extra couple $1,000s over the course of a year to be in a house that you want to be in right now? I think it makes some sense. I mean, it's $7 a day. That could be your favorite overpriced coffee and some food to go with it. It could be your favorite takeout that you just set aside. I mean, $7 a day. Is that too much to pay to get in the house that you want? Is that, is really a $7 a day getting in the way? There's another strategy within that, and while some people get a little bit nervous about it, this might be the time to take a second look or a first look at an adjustable rate mortgage. You see, when rates are 2 or 3%, most of the adjustment is upward. But when rates are 7 or 8%, you have to look at the margin that could go up or down. And let's just suppose that you're in that 7, 8% range, and it could adjust up or down 2%. So if 2 years down the road, 3 years down the road, the ARM period might be a 3-year adjustable, a 5-year adjustable. It'll adjust on that date, 3 years down the road, let's say, up or down 2%. If you're paying 7.5% right now, it'll automatically adjust down to 5.5%, and then it might just adjust annually, ongoing. It's a pretty good rate drop at 2% at no cost. It automatically comes down if the rates are lower. So if you have not looked at adjustable rate mortgages and you're not sure about them, that's where we can help. And we can certainly consult on that topic with you. We got some great lenders who explain it away, and chances are you know a great lender as well. So when we talk about adjustable rate mortgages, they don't have to be scary in this market. They just don't. And if it was to adjust in 3 or 5 years, that's going to get you a better rate down the road, save you some money. It may not be as important down the road. Now, the last thing I want to talk about is if you have a property that you're thinking of selling in order to buy another house, and you're addressing wealth building strategies through things like 401k, and also have you considered keeping the house and using the home equity line of credit tool? So many people I know have mortgages in 2 and 3%, and when they give up that rate, when they sell the property, it goes away. It's not likely to return. And a home equity line of credit to get you $20, $50, $100,000 for a down payment on the next house while you're still living in it, you acquire that money, you use it as the basis for your down payment on the next house, and then you rent the property out. And a lot of people are at least breaking even on that, but let's just suppose that you take an equity line out for $100,000, and by the time you add up your first mortgage payment, your home equity line, and it comes to a number that's maybe $100, $200 cheaper than what you might pay out. You have a little positive cash flow. That's great. But if it goes in the other direction and you actually have to come out of pocket a couple $100 a month, I would just ask you, would you trade $200 a month to put your hand on $50,000 or $100,000 to buy another house that could also go up in value? Absolutely. And as a renter in the home paying your mortgage, there's equity within that. And let's just suppose that you're $200 out of pocket to acquire the money after renting it out, but the mortgage balance is coming down $500, $600, $700 a month. That's equity. It's hidden. You don't see it. You can't grab it. But if you already have a 401k that you can't touch, and there's equity in the house that you're not touching, but it also is leveraging the value and equity in the house to buy another one, and to have 2 mortgages being paid down and 2 sets of equity building, then it might be worth it. Now, that's a lot to digest. Let's just say that because the market's gone up, you've got 100, 200,000 in equity. Would you want to unlock 50 or 100 of that to go buy another property? Rent the one out that you live in, come close to breaking even, maybe come out of pocket a little bit, but buy another house too? You see, that can happen. And it's the reality of this market. And so far, we've come up with more than a few viable strategies to overcome the interest rate. And now I'm asking you, so what is the reason that you wouldn't buy a house right now? And as a salesperson, that might be a conversation I have with clients that come in, but in the space of this podcast and consulting, I wanted to walk you through the steps of how we are able to navigate something that seems too expensive, and now you're armed with information that can help you make a decision for whether or not it's the right time to buy. And that's the point of this podcast, is to give you the tools and information that you need to make great decisions in your personal life in a safe space outside of this. Unless you know how to reach me through this portal over here, you're not necessarily lined up to be a customer over here. What I want to do is inform and provide opportunity for those that are in the market and really unsure of where to turn, where to trust, and since I'm in a safe space right now where the only outcome for me is to help people. I believe that we're giving you what will help you navigate these times. The fact is, I think it makes sense to buy any market if there is an overall benefit layered on top of what is important to you in your personal situation. So there you have it, a way to purchase in the end of the year strategies that make sense, that also overcomes these higher interest rates. All right, I look forward to catching up with you again next week. Hope you enjoyed this one. If you do, hey, put a comment below, subscribe, and we appreciate you. This is Ron Wojciechowski for the Black Hole of Real Estate.